Because ultimately what that does is it's an admission that the currency is failing. It is a revaluation not of the metal, but of the currency. Gold and silver are much simpler than most people will have you believe. Real interest rates are such an important topic, such an important factor in determining whether things are bullish or bearish for precious metals. We had a bear market in gold and silver and precious metals for 22 years. Today, you're probably going to hear many people talking about war, talking about politics, talking about the news cycle. And I say this is just noise, and it's really just to be ignored. Understand why real interest rates work against you. Understand why saving in cash is actually putting you at risk of being stolen from via not only inflation, but of course these real negative interest rates, which is what the precious metals market follows. Wow, I'm surprised at how many people are here. I haven't presented face-to-face to people in years. I've got some cue cards to keep me on topic because I'm very good at going off topic. So BGM. That is me, and I am known mostly from my YouTube channel, Bald Guy Money, where I have more than 125,000 subscribers, more than 14 million views. And for those of you who don't know me, I am Canadian. I moved to Poland in 2007. And for those of you wondering, yes, I do speak Polish. I was an economist and an analyst. In fact, I worked right next door in Jerozolimskie 94, which is the Equator building, for many years before moving to Dubai, where I lived for 7 years, and was a head of marketing and strategy for a tobacco company there for 9 countries. And I started my YouTube channel in 2021 on the advice of my wife, who thought people might be interested in hearing what I have to say, since I was managing our finances well, which led me, of course, to retirement in 2024. And now I'm really only doing the YouTube channel full time. And essentially, this entire time, I have been bullish on hard assets. Ever since 2008, and I watched Ben Bernanke at the US Federal Reserve print $1 trillion. On top of borrowing another $600 to $800 billion from the Chinese to save the world from the global financial crisis. Now, when it comes to gold and silver, my thesis is very simple. It's probably the simplest thesis you're going to hear today. It doesn't involve anything complicated. It involves one main thing that I look at, which is real interest rates. Real interest rates that started a bull market for gold and silver in 2002 that, as far as I'm concerned, despite the pause that we experienced between 2011 and 2015, is still ongoing. It hasn't stopped. Now, our story today starts in 1944. Many of you are probably familiar with the Bretton Woods Agreement, when the United States dollar, which was pegged $35 to 1 ounce of gold, was made the global reserve currency. And it was a very convenient thing for the world to be able to hold these US dollars, hold US debt, and earn some yield from it, considering the fact that they weren't getting any yield from their gold. But the fact that they could convert their dollars at $35 to an ounce of gold was very convenient and made people feel that the US dollar was something that could be trusted, especially as they were exiting the Second World War, where the United States kind of asserted itself as a major global power and came out of the war untouched. Now, you can see this photograph here. Does anybody know who the old guy is standing next to Richard Nixon? I'm sure many of you recognize Richard Nixon. Does anybody recognize the old person standing next to him? Yes, that's right. There's even a roundabout, Charles de Gaulle, with a statue of him here in Warsaw, not far from here. And in the mid-1960s, Charles de Gaulle, smart guy, I think controversial for some reasons, especially me as a Canadian, since he encouraged Quebec to separate from Canada, but he wasn't a dumb guy. And by the mid-1960s, what you saw was you had a new president, Lyndon Johnson, after the assassination of John F. Kennedy, who was fighting a war on poverty. Some of you might know that, some of you might not, but the welfare state in the United States started to grow significantly. At the same time, the United States was fighting an unsuccessful war in Vietnam, and Charles de Gaulle noticed that a lot more dollars were starting to come on the market, which between 1963 and 1966 forced him, I say forced him, let's say encouraged him to exchange about $400 million that the French central bank was holding in reserve in US debt into gold. France actually sent even warships, not in an aggressive capacity, but in a transportation capacity, to take that gold out of the United States, out of New York, and bring it back to France. And by summer of 1971, many of you will know that Richard Nixon ended the link between the US dollar and gold. He closed what was called the gold window and said, you can no longer exchange US dollars into physical gold out of fear that the country's gold reserves were going to be completely depleted. Now, as a result of that, we saw from August 1971, when that artificial ceiling was removed from the price of gold, to the end of 1974, we saw the price of gold rise to almost $200 an ounce, which was a 459% increase over a very short period of time. And for anybody who watches videos on YouTube or hears people talking about the revaluation of gold to $8,000 an ounce, $10,000 an ounce, or $15,000 an ounce, will have an easy time understanding why I think that is bullshit and that you should never accept some kind of artificial price, even in a revaluation that over a short period of time benefits you, because ultimately what that does is it's an admission that the currency is failing. It is a revaluation not of the metal, but of the currency. And that's why I much prefer the free floating system that we have today, despite all of the manipulation. Now, coming back to our story here, understanding, as you've seen with the gold chart, that the US dollar was under major pressure, things looked kind of ugly, in fact, for the United States in 1973 and 1974, they had to find a solution to keep the dollar's position as the global reserve currency strong. So Henry Kissinger here, who is in the photo, flew to Saudi Arabia. I've done business in Saudi Arabia for a long time during my 7 years living in Dubai. And they made a deal with the Saudi royal family saying, if you accept only US dollars in exchange for oil, and you encourage other OPEC members to do the same, we are going to protect you militarily, which also included, of course, propping up these royal families in these countries whose positions are, not that stable from time to time. But the United States guaranteed their stability, guaranteed their protection, as long as they accepted dollars for oil, which established what we know today as the petrodollar. Now, at the same time, as you can see here, this is the federal funds rate from 1970 to 1974. And to fight inflation, the central bank said we're going to increase interest rates. And they increased the interest rate from below 4% to 13%, thinking that would kill the inflation the country was experiencing, along with this petrodollar, and re-establish the US dollar as a trusted currency worldwide to be used, obviously, as the main reserve currency. And as you can see here, this is the US dollar index, something very important that I think every gold and silver stacker should be following to see exactly how strong the US dollar is, as usually the relationship between the price of precious metals and the US dollar is an inverse one, where the dollar goes down, metals usually go up. And when the dollar goes up, usually there's downward pressure on the price of precious metals. Not always, but it often happens. And as you can see here, after the establishment of the petrodollar and after the interest rate had been increased, the US dollar stabilized and it reached back above 100 on this very well-known index. At the same time, between the end of 1974 and 1976, as you can see here, the price of gold fell by about 50%. And I think at the time, the United States thought that all of their problems were solved. Gold was kind of out of the way, the dollar was recovering, the world was good. But despite this, it wasn't over. Sorry, I got to get rid of these cards. Keep myself focused. So, it wasn't over. Because as you can see here, the money supply in the United States continued to grow. In fact, it almost tripled between 1970 and 1980, because despite all of this desire to keep the dollar strong, to keep it used in the global economy and make sure that it was safe from being replaced by potentially, for example, a return to the gold standard, a lot of the behaviors that led to the depegging of gold from the US dollar remained. The United States was still spending too much money, which is a story I think we're all familiar with today. Now, this is annual CPI, so the inflation rate that the United States experienced in each year from 1970 to 1980. And what you can see is that despite the establishment of the petrodollar, despite those temporarily higher interest rates, inflation actually got stronger in the second half of the decade than it was in the first half of the decade. Which brings us back to what I said at the start, real interest rates. Gold and silver are much simpler than most people will have you believe. Real interest rates are such an important topic, such an important factor in determining whether things are bullish or bearish for precious metals. And most people, number one, aren't aware of it. And number two, even people who are aware of what real interest rates are don't follow these trends close enough. And for those of you who might not know what a real interest rate is, it's as simple as this. What percentage are you getting on a government bond? What percentage are you getting on a certificate of deposit? A certificate of deposit in Poland is called a lokata. What percentage are you getting as a return on your money in a money market account minus inflation? Okay, you have to factor in inflation, because if you don't factor in inflation, you don't really understand what the return is. And when this number, the real interest rate, goes below zero, those are the moments it pays to borrow money and put them into hard assets. And we see the market react this way every single time, because essentially what's happening when interest rates go negative on a real basis is you are being paid to borrow money, as the value of hard assets appreciates faster versus the currency that you borrowed to buy it. And by 1977, because of all this bad behavior, the expansion of the money supply, the fact that all of the bad behaviors the United States was participating in, many of which they're doing again today, real interest rates went negative again by February 1977, which was a month where gold went up 7.9%. And that was the moment the second leg of the major bull run in precious metals was initiated, when those real interest rates went negative again. And you can see here that by July 1978, gold made a new high versus that December 1974 number. And by January 1980, during the blow-off top, when it reached nearly $900 an ounce, the price of gold had appreciated 347% versus that previous December 1974 high, and 2,394% versus the $35 per ounce peg that had existed and was imposed basically by the United States after Bretton Woods for years upon the world. Now, we know that it didn't end well, because by 1980, this man, Paul Volcker, some of you might recognize him, this was a real man. He's in there at the Fed meeting, he's smoking a cigar, he didn't care what people thought about him, he got death threats for the things he did, but he was a real man who understood that sometimes to get gain, you need to have pain. And that's something our leaders today simply don't understand. They have the weakness that they cannot say no to the voting public. They have the weakness that they cannot do what is right over the long term because they want things to be comfortable over the short term. And what this man did, Paul Volcker, was he raised the interest rate in the United States to 19%, at which point real interest rates, so the real amount of money minus inflation, what you were earning by purchasing a US government bond, went up to about 7% regularly, kind of on and off, between the period of 1982 and 1984. Meaning that if you had cash, or maybe even if you were holding gold, it made more sense to put your money in these US bonds and take the 7% because it was basically low risk. Some people like to call it risk-free, but we're going to come to that in a moment because that risk-free has gone away. Now, at the same time this was happening, many of you might recognize this. This is, of course, the Berlin Wall and the end of the Soviet Union. And what happened as a result of this action, a lot of people also underestimate the impact this event had on precious metals, in that the end of the Soviet Union basically resulted in the United States becoming the winner of the Cold War, the preeminent global superpower, leaving the US dollar, which was now actually yielding a positive real return, as the most important financial, let's call it, thing existing in the financial system. And as a result, central banks, they looked at what had happened. They obviously wanted to cozy up to the United States. They saw the US dollar and the military that backed the United States as the only superpower in the world, as something that was absolutely going to remain the core of the reserve system. And as a result, as you can see on the chart here, from about the mid-'80s, when they saw the writing on the wall, the end of the Soviet Union, all the way up until 2009, central banks sold their gold. And what they did with that money was they took it and they put it in US debt, from which they could earn low-risk, guaranteed returns. Of course, gold doesn't yield a return, right? We know that. Now, that lasted for 22 years. We had a bear market in gold and silver and precious metals for 22 years. Because for the entirety of time, from 1980, when Paul Volcker increased interest rates to 19%, all the way up until 2002, as you can see by that blue line on the screen right there, real interest rates remained positive, which meant people saving cash were not at the same level of risk that they are today. But in 2002, that number went negative for the first time since 1980. And if we look here at a chart showing the annual change in gold price each year from 1996 to 2026, each candle, each stick on this chart is 1 year for gold. You can see that the price of gold, coincidentally, I would say not a coincidence, increased by 25% in 2002. It was the biggest 1 year gain in the price of gold since 1979. And the reason is because of real negative interest rates. Money left the bond market. It left certificates of deposit. It left money market accounts because that is where you were guaranteed a loss. And it shifted into hard assets. It moved into gold. It moved into silver, both of which had, because of new demand, ETFs launched in the early 2000s to make it easier and frictionless to get into gold and silver. We also saw during this period, especially in the United States, leading into the real estate crisis, the prices of hard assets like land and homes increase also significantly. And this, as I said, is not a coincidence. Every problem in the 21st century, when it comes to how our central banks and how our governments are managed, every problem has the exact same solution. And I think we know what that solution is. It is lower interest rates, and it is the injection of fake money into our financial system. Now, after the global financial crisis, when Ben Bernanke at the Federal Reserve printed up $1 trillion, when they borrowed another $800 billion from China to bail out the financial system, central banks started to realize that the writing was on the wall. Those returns, those guaranteed low-risk returns, since real interest rates had gone negative again, weren't guaranteed. The debasement of currency was going to start to accelerate as these problems around the world got worse, specifically promising more to the voters and to the citizens of the countries than the countries could actually deliver based on the taxes they were receiving. And we'll talk about that as well more in a moment. But by 2010, as you can see here on this chart, central banks started buying gold again. It was not a barbarous relic, as some had said it was. In fact, it was the real base of the global monetary system, as it should have been, as was established more than 4,000 years ago. And in 2022, you can see that central bank purchases of gold increased. And we know why that is. And, you might have different thoughts about Russia, especially in Poland, about the war in Ukraine. But that is when the United States, under the Biden administration, violated the neutrality of the US dollar. They froze Russian assets, whether you agree with it or not. I really don't care, because money doesn't care about how you feel about situations like this. Let me make that perfectly clear. And central banks, both large and small, started to buy gold more intensively because they realized that gold is the only reliable and neutral reserve asset in a new world, one that existed and one that was created in the fallout of COVID-19. Now, today, you're probably going to hear many people talking about war, talking about politics, talking about the news cycle. And I say this is just noise, and it's really just to be ignored, because ultimately this is not what is driving the precious metals market. It all boils down to math. Now, when we look at the math and we look at the world's money supply, you can see here that we're now above $100 trillion when it comes to the world's 4 major central banks. That's up from 50 trillion, so a 100% increase since 2013. And it's an increase of a significantly higher order, more than $80 trillion since 2000, when the global money supply was about $16 trillion. At the same time, the United States is $40 trillion in debt. Demand for that debt is starting to erode for obviously political reasons, but the debt itself is simply unsustainable at this point. And in an effort to keep short-term interest rates down, what we can see is, since December of 2025, the Federal Reserve in the United States pivoted from reducing its balance sheet, so kind of destroying money that it had created and lent out to people, to immediately pumping it back into the market. Now, if we're to believe President Trump, everything is okay. The American economy is the hottest economy in the world. But when I look at this chart of what's happening in the Federal Reserve, it tells me a completely different story, with the Federal Reserve in each of the last 8 weeks pumping money net into the market, buying US debt that nobody else wants, to keep lending, or to keep interest rates, I should say, low, because the United States already cannot pay and cannot afford the interest payments on their debt, which is now above $1 trillion per year. At the same time, all of this new money is being created and devaluing, debasing, and diluting the currency that we use every day, and we've noticed it in the prices that we pay for things. The Federal Reserve, according to the latest CME data, has a higher than 50% chance of lowering interest rates still once again in 2026, despite the fact that inflation is rising. This is very much a 1970s situation, and real interest rates today are already down to 0.4%, and they're about to go negative, which tells me that the bull market for gold and silver, although it may have taken a pause since January of this year, it is not over. It is not over by a long shot. The metals bull market is going to sustain for many more years because, as I said earlier, and I said I would come back to this topic, governments have promised much more than they're able to affordably deliver to their voters. This here, what you're looking at, is US government data showing the Social Security Trust in the United States, which by the United States' own government data is going to run out of money by 2033, at which point people who receive Social Security today, most of them elderly people, are going to have to receive a 25% cut to their benefits. And if you think that 25% cut is actually going to happen, then I'd call you a fool. Because what's going to happen is the United States is going to borrow, and they are going to print the difference by the time this happens. And the same thing is going to happen in Poland with Zeus. And it's going to continue to debase and dilute our monetary base. And I'm going to finish with this. In the 21st century, technology and improved industrial processes mean that prices should actually be going down. But when we measure them in our currencies, taking the iPhone for an example, which is a famous example that I've presented on my YouTube channel many times before, if we look at the first iPhone, which has increased in US dollar price by 60% since the first model was introduced in 2007. When we measure that price in real money, being gold and silver, which actually reflects all of the benefits that we get from improved technology and improved industrial processes, you can see that the price of an iPhone in gold has decreased, based on today's prices, by 79% versus that first iPhone, and has decreased by 76% when measured in silver. So I'm imploring everybody today, understand why real interest rates work against you. Understand why saving in cash is actually putting you at risk of being stolen from via not only inflation, but of course these real negative interest rates, which is what the precious metals market follows. Because we are really today, in the month of April, on the eve, in the last weeks of seeing real positive interest rates. They are about to go negative, and the next leg up in the precious metals bull market is about to begin. Don't get caught swimming naked. Have at least 10 to 20% of your net worth in precious metals to protect you for what is about to come next, and hold it for a long time, understanding, as in the case of this iPhone showing what's happened over the past 12 years, that you are going to benefit. The purchasing power of the gold and silver you buy today over longer periods of time is going to buy you more goods and services in the future than it does today. All you have to do is wait for it to happen. And that's all I have to say. Thank you very much for watching my presentation.